Market speculation often begins with intense observation of short-term price movements. Traders analyze patterns like candlestick charts to predict immediate market shifts. This focus on rapid changes is driven by the pursuit of quick financial gains. Such speculative behavior is frequently fueled by the excitement of market volatility. It often occurs without a deep, foundational understanding of underlying market mechanics. A speculator's mindset often involves a belief in superior market intelligence. This can lead to chasing rumors and reacting impulsively to market shifts. Perceived success becomes tied to immediate numerical changes, not sustainable growth. This creates a cycle where short-term gains are prioritized over long-term stability. Legendary traders like Jesse Livermore experienced both significant successes and failures in the market. He recognized that market engagement requires discipline and emotional control above all else. Mere intelligence or chart-reading ability is insufficient for consistent trading success. A primary cause of trading failure stems from a lack of self-awareness and emotional management. The market environment is characterized by constant fluctuations and unpredictable movements. Success in market activities is not primarily driven by intellectual capacity or raw intelligence. Instead, the market significantly rewards consistent discipline in decision-making. Effective emotional management is also a crucial factor for navigating market dynamics. Discipline and emotional control prevent impulsive actions during volatile periods. These attributes enable rational choices, leading to more favorable long-term outcomes. For traders, a critical insight is the primacy of internal factors over external market data. Understanding one's own psychological biases is fundamental to successful trading outcomes. Emotional responses also play a significant role in dictating trading decisions and results. These internal psychological and emotional aspects often override objective market analysis. Therefore, self-awareness is more crucial than solely analyzing market trends or indicators. Ultimately, internal factors frequently determine the success or failure of a trading strategy. The Richest Man in Babylon introduces foundational principles for wealth accumulation. These principles emphasize enduring financial habits over transient market predictions. The core focus is on establishing robust financial practices for long-term prosperity. It contrasts sharply with speculative tactics for rapid, but often unstable, gains. The approach prioritizes consistent, saving, and wise investment over complex financial instruments. It advocates for timeless strategies for financial security and growth. The pay-yourself-first concept is a fundamental principle for wealth building. It advocates for consistently saving a portion of income before any other expenses. Typically, this involves setting aside around 10% of earnings as a priority. This establishes a habit of capital accumulation, prioritizing financial growth. The Babylon Principle emphasizes a consistent, regular investment strategy. This approach goes beyond mere saving, focusing on active capital deployment. It involves regularly investing accumulated capital into suitable assets. The core objective is to allow the invested capital to grow steadily over time. This strategy deliberately avoids attempts to time market entries or exits. Consistent investment leverages compounding, fostering long-term wealth accumulation. Capital protection is a fundamental principle in financial management and investment strategies. It emphasizes safeguarding initial capital, which serves as the foundation for future wealth generation. This approach prioritizes the preservation of principal over aggressive pursuit of high returns. It stands in contrast to speculative methods that often expose capital to significant risks. Such speculative strategies aim for quick, substantial gains, but carry a higher potential for capital loss. The concept of gold multiplication refers to a strategic approach to wealth. It involves deploying capital into productive assets rather than mere accumulation. These assets are specifically chosen for their ability to generate further returns. The core principle emphasizes growth through intelligent investment strategies. This method aims to expand wealth by making capital actively work and produce. Speculation primarily focuses on predicting and capitalizing on short-term price movements in financial markets. This approach often involves high-risk strategies aimed at quick gains, treating wealth as a fleeting event. In contrast, the Babylon approach emphasizes building a robust financial system. This system is designed for the long-term accumulation of wealth, prioritizing stability and growth. It views wealth as a structured entity, built systematically over time, rather than a temporary occurrence. Speculation in finance is comparable to a sprint, focusing on rapid, short-term gains. It prioritizes quick wins, often involving higher risks for immediate returns. Conversely, Wealth building is a continuous process, akin to constructing a durable structure. This approach emphasizes long-term growth and stability, creating lasting financial resilience. The book, Rich Dad, Poor Dad, emphasizes a key financial principle. It distinguishes between focusing on income and acquiring asset. Income, often derived from active labor, can be fragile and temporary. Assets, conversely, are powerful financial tools. They generate wealth independently, without requiring continuous active labor. An asset is fundamentally defined by its ability to generate income. It is anything that consistently puts money into an individual's pocket. This income generation occurs regardless of active personal labor or direct involvement. Assets are crucial for creating passive income stream. Ultimately, assets contribute significantly to achieving financial independence. In financial terms, a liability represents an obligation that requires future outflow of economic benefits. It is anything that effectively takes money out of an individual's or entity's pocket. Liabilities diminish existing financial resources, reducing overall wealth or capital. They create a financial burden that must be settled over time. This can lead to increased financial dependence on external sources or future income. Understanding liabilities is crucial for assessing financial health and making informed economic decisions. An investor and a speculator approach financial markets with distinct objectives. A speculator primarily aims to profit from short-term price fluctuations in individual trades. Their focus is on achieving capital gains through buying low and selling high. Conversely, an investor prioritizes owning assets that consistently generate cash flow. This strategy emphasizes long-term wealth creation through dividends, interest, or rental income. Speculators and investors approach financial markets with distinct objectives and strategies. A speculator primarily focuses on short-term market movements to generate profits from price fluctuations. Their strategy involves buying low and selling high, or vice versa, often within brief time frames. Conversely, an investor aims to build a portfolio designed for long-term growth and stability. The investor's primary goal is to generate consistent cash flow, creating a steady stream of income. This fundamental difference defines their risk tolerance and financial outcome. The book, Think and Grow Rich, explores the profound connection between mindset and financial success. It highlights that subconscious beliefs about money significantly influence an individual's financial outcomes. These deeply ingrained beliefs can either support or hinder the accumulation and retention of wealth. Negative subconscious beliefs about money often lead to patterns of self-sabotage. Such beliefs can manifest as behaviors that prevent financial growth or lead to the dissipation of wealth. Therefore, understanding and reshaping these core beliefs are crucial for achieving financial prosperity. Individual beliefs about wealth significantly influence financial behavior and outcomes. A core belief that wealth is temporary can lead to specific financial actions. Similarly, believing wealth is difficult to maintain shapes financial decisions. These underlying beliefs often manifest as behaviors that undermine long-term financial stability. Such perceptions can inadvertently prevent individuals from achieving sustained financial well-being. Financial markets often amplify inherent psychological traits within individuals. Fearful individuals may react to market volatility by engaging in panic selling. This behavior can lead to significant financial losses due to irrational decisions. Conversely, greedy individuals might over-leverage their positions in pursuit of higher gain. Excessive leveraging can expose them to disproportionate risks and potential ruin. Both fear and greed contribute to suboptimal financial decisions within market environments. Speculation involves engaging in financial transactions that carry a high risk of losing most or all of the initial outlay. It is driven by the anticipation of substantial gain, often over a short period. This activity frequently triggers a dopamine response in the brain. Dopamine creates feelings of excitement and reward, reinforcing speculative behaviors. This neurochemical effect can lead to an addictive cycle, prioritizing thrill over stability. It often distracts individuals from the more stable, less thrilling process of long-term investing. Disciplined investing prioritizes stability over the excitement of speculation. It focuses on achieving sustained, long-term growth for financial assets. The core objective is the creation of enduring and robust financial structures. This approach contrasts with short-term, high-risk, speculative activities. Investment strategies often diverge between market timing and foundational wealth building. Speculation primarily involves market timing, aiming to predict short-term price movements. This approach relies on forecasting market fluctuations to buy low and sell high. True wealth building, conversely, focuses on establishing a robust financial structure. A sound financial structure is designed to endure and thrive despite market volatility. The speculator's trap describes a common pitfall in financial decision-making. It arises from the desire for rapid wealth accumulation and immediate financial success. Individuals caught in this trap prioritize quick, exciting gains over sustainable growth. This often involves engaging in high-risk investments or speculative ventures. They overlook the slower, yet more reliable path to financial freedom. Consistent, disciplined financial strategies are often perceived as boring, but are more powerful. Building lasting wealth is not primarily driven by intelligence or fleeting excitement in the market. Instead, consistent discipline forms the fundamental cornerstone of financial success. Discipline is applied through strategic asset allocation, diversifying investments wisely. It also involves robust risk management, safeguarding capital against market volatility. Furthermore, discipline fosters a commitment to long-term ownership of assets. This sustained, methodical approach is what truly allows wealth to accumulate and endure over time.